Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to Peter Harris, Exec Chairman of Northbridge Industrial Service, a global load bank rental and sales business. So welcome, Peter.
Hi, Paul. Nice to be with you again.
Yeah, well, big congrats on this morning's Inline trading update, and with Crestchic load bank sales and rentals going up 20% like for like, so a stellar performance there. What's actually been driving the growth for that particular division?
Well, it has been a very strong performance last year. I think the dominant features were firstly continuing strength in the data center market, and as you know, when we've talked before, this has been something for 5, 6, perhaps even 7 years now. It's been growing very strongly worldwide. And there are sort of multiple streams of revenue for us from the data center market, from heat testing, commissioning, retesting, backup power supplies, testing battery backups. So it's a very strong market for us, and it's done very well for us and continued through 2021 and shows every sign of continuing through 2022 and continuing to grow. So that was really good. The other thing that happened last year was we got the pickup post-COVID. In 2019, the major hire projects were really quite badly impacted by travel restrictions. We couldn't get our equipment to site. Operators of tests couldn't get their technical staff to site. So there's quite a big dip in our major project rental revenue in 2019. And that recovered in 2019 through to 2020, and that recovered last year. So we saw some big activity in the shipyards in China, for instance, which was really good, and that's continuing again this year. And the general infrastructure side of the business responded well.
Yes. So what about the US? Because I understand you just sort of set up a depot out there in Texas.
You're absolutely right. I mean, you've been following the company for a long time. You know, we've had a very steady launch into the US market over the last decade or so. We started out selling through an agency in West Coast, Hawthorne, cat dealer. They've done very well for us, continue to do very well for us. We have a small sales force now starting to cover the rest of the country, still big untapped potential there. We opened our first hire depot in Philadelphia about 3-4 years ago. That's now approaching capacity and going strong. So we've been planning for a while to put a second depot in, and there'll be more to follow. And Texas just shone out as the right location. All our traditional markets are well represented there. The maritime industry, extractive industries, oil and gas, etc. But it's also the hotspot for data centers. And we've been talking about data centers in Europe and other areas of the world for some time, but we've never really entered the data center market in the US. Yeah. And this is the opportunity for us.
Yeah. And we've just had a great example of why the world needs load banks just on backup power, because we've just had Storm Eunice, and that's one of the reasons. Just for people who are watching this, that's the reason that Peter's switched to his mobile, is that he's had a power blackout from the local electricity board. So, as if you want to sort of add to that one, Peter, why it's so important to test your backups.
Yeah, it's quite a storm, this one, and we've been out twice already today, and I suspect there'll be more to follow. And I think what we're seeing, and again, this is something we've talked about, that we hate to profit from other people's misfortunes, but climate change is one of a number of factors that's impacting on grid stability and grid reliability. And we're in a connected world today. You need reliable power supplies. And sadly, things like Storm Eunice are only going to be good news for our business, even if they're quite inconvenient for this interview.
Yeah, well, I mean, you shouldn't apologise, because you're actually doing a service to keep the lights on. We absolutely desperately need you guys. But yeah, just on that one, I mean, one thing which sort of like shone out is that you mentioned you've got strong demand looking into 2022, and you probably would have sold a lot more load banks as well in 2021 if you'd have had sort of capacity. But can you just walk us through that sort of like increase in production facility? It's sort of like mid-year in Q2.
Yeah, well, that's going well as well. I mean, we got planning permission in the middle of last year. It took a while, but it came through in the middle of last year. We broke ground around September. We did have some delays in the fourth quarter, just availability of staff and materials from the supply chain issues that are bedeviling everybody. and COVID problems with getting people on site. But that's all behind us now. So the steel frame's up, the roof is going on as we're talking. Walls are climbing up to meet the roof, and we're very confident we'll be in production in May.
Great. And how long do you think it will take, basically, to fill that capacity out? I mean, it's out, 'cause you've got another record order. Every time I speak to you, you've got a record order book there, Peter.
Well, it's 4 years in a row now, and that's a pretty good track record building. And the sales guys know that I won't be a happy bunny if it doesn't turn into 5 in 10 months' time. So they're all out there selling, storm units or not. Yeah, I mean, it's a 60% increase in capacity, which is significant. So we're not going to fill it overnight. But there are two things that will impact on it quite quickly. Firstly, yes, demand is very strong, and definitely sales were constrained last year. So we'll be able to pick that, that constraint will be eliminated from May going forwards. The second thing is we haven't really been able to build for the hire fleet for the last couple of years because we've been so busy fulfilling direct sales orders. And we've done some really creative things about finding used equipment in the marketplace, bringing it back, refurbing it in our depots rather than in the factory. We've put, best part of certainly well north of £500,000, probably at replacement cost, £1 million worth of equipment into the hire fleet over the last 12 months through doing that. But there's still some latent demand from the hire salespeople to refleet. And also we need to build fleet in some of the hot data center areas. So that will chew up a bit of capacity as we accelerate the hire fleet growth. In terms of sustaining a 60% increase, that'll take several years to get up to that. And the good news is, we've just employed a new technical director, came to us from Rolls-Royce. I think, it's lovely now that people are choosing Crestchic instead of Rolls-Royce. How about that, hey?
Absolutely great.
He's a fantastic guy. He's got great pedigree in R&D and innovation, as you expect, coming from Rolls-Royce. Fantastic supply chain experience and excellent manufacturing capability. And I know he's already looking at how we make things and how we can actually relook at our whole production process in the context of a larger factory and drive efficiency up. So I suspect that 60% will become something rather larger than that when we absolutely maximize the sort of skills he's going to bring to us. So it'll take a little while, but my mind is already turning to the next expansion. So
oh, good. Well, I mean, I would have thought, given the size of the US and the problems they have in terms of keeping the lights on, you mentioned Texas. I mean, they had huge issues last year. Likewise, every single, sort of summer with the wildfires, California has to turn stuff off. I mean, those are just 2 states, albeit obviously quite big, and they've got massive amounts of data centers. I mean, they are just hugely stuffed with data centers, both of those states, with Silicon Valley and obviously with Austin in Texas and Dallas and stuff like that. So presumably you're going to need a lot of factories just pumping out these Crestchic load banks, aren't you? Just to fill your own fleet as much as anything.
We are, but again, in the data center market, we're not shy of actually co-manufacturing through other people because the US specifications are different. At the top end, the sort of equipment we sell in there, people are really happy with what we do. But down at the data center end, there's locally manufactured stuff that's very fit for purpose, which would be difficult for us to replicate cost effectively in the UK. We've just signed our first purchase order with one of the US manufacturers who's very keen to work with us. And that means we can actually build the data center fleet in the US without compromising factory production in the UK. So that's positive.
Okay. And what about the supply chain pressures? How are they sort of like, how are you seeing those going forward alleviating?
Well, it's definitely alleviating. I think we sort of felt we were turning the corner around about December time. We suddenly felt it just easing a little bit. It really was a pest last year. I mean, our procurement people did a fantastic job, but they had some really interesting issues to deal with because we've got quite a global supply chain. And a lot of the stuff we buy, just simple things like chips for our control system or copper for the wiring, etc. I mean, these are things that are in great demand around the world. So we're competing with lots of other people to secure our supplies. So it was difficult last year. But we feel we started to get on top of it towards the back end of the year, and it's definitely improved in the first quarter again this year. And we're hoping that we'll be in a reasonably normal position by the end of this year. I mean, we're quite fortunate in a way. When COVID first struck, we actually spotted the possibility of supply constraints, and we built up our stocks quite significantly of key components. And in fact, in the early months of COVID, there wasn't much of an issue. We were just starting to think about, do we want to start running some of these stocks down when all the mayhem of global shipping, etc., struck? And we were sitting there with stock that we were rather pleased to have, and that helped us get through last year.
And what about you in the interims? You mentioned that you'd incurred some input cost inflation. How are you getting on in terms of, sort of like being able to transfer some of that input cost inflation through price increases?
Well, we've transferred all of it to date. We had 3 price increases last year, and that's right. I think that's the first time ever in our history. Normally, we have an annual price increase. There are some years where we don't even have a single price increase, but typically we'll have 1 increase at the start of the year. But we had 3 last year. We're just rolling out our first price increase of this year. Hopefully the last price increase, but we're not by any means guaranteeing it. And it's not just been on materials. I mean, as you know, we're starting to see payroll inflation. Not just in the UK, fortunately. This is a global issue. So our customers know the constraints we're operating under, and I think they're finding similar issues themselves. So it's never easy to get a price increase through, but they recognise the realities of life. And so far, we have been able to pass things through. To the extent we've had a little bit of margin pressure, it's primarily been around production inefficiencies, as a result of supply chain issues, as a result of staffing issues, as we've managed safe working practices through COVID. And those are starting to ease now. We'll hope to see those recovered.
Okay, good. And can you just now talk us through the Tasman side of it? Because obviously that's the sort of the gas drilling and thermal drilling tools and oil drilling tools business out in Australasia and elsewhere.
That's right. We took the decision at the beginning of last year that we should divest that business. It was seen as a good enough business, though it had a difficult few years in the run up to last year. But we just saw such significant opportunities in Crestchic. As you know, we really wanted to focus our strategy, our management attention, our financial resources on building Crestchic. And I'm a great advocate of simplicity. So having another division, which had really consumed a lot of time and money turning it around after the difficulties in the oil price crash, 7-8 years ago, we took the decision that we'd dispose of it. And really, there are 3 pieces to it: the Australia, New Zealand operations, and we announced the disposal of that today. The Malaysia, Singapore operations, and we announced at the year end that we'd exited our joint venture there and we're disposing of the assets, which is now complete. And then we have a small operation left in the Middle East, which I'll turn our attention to now. So we're well on the way to completing the exit of the business. It's taken a little while because it's quite a complex structure. But I think importantly, a transaction like this, it's got to be right for us and our shareholders. It's got to be right for the buyers of the business. But we're very focused on our people. We're very focused on our customers. And we want to make sure that any deal we do looks after those stakeholders as well. And I think, we've accomplished that. Pleased with the way we've gone about it. So it's great. Yeah. So cash will be coming in from that. So it's a business that didn't make any money last year, and for the years before that had been losing money. So to have that cash to reinvest in Crestchic is great news for us.
Yeah, well, that's exactly the point. That's exactly the place I'd like to move to now, because before you've been reducing the net debt position over the last couple of years, and now you if you add that 4 million that you've just brought in from your Australia, New Zealand disposal, presumably you're in a nice sort of like net cash position as we sit, or you will be once you get the cash.
We will be. A chunk of that will go out in the factory because with the problems we had getting people on site in the last couple of months of last year, though that irritated us a little bit by delaying the construction, it also pushed some of the payments out into 2022. So we do have a chunk of money to go out in the factory construction, but it's not 4 million, that's for sure. The whole project only costs 2 million. So we are sitting. Once the cash comes in on Tasman, we'll be in a small net cash situation. And we'd hope to stay round about neutral on net cash or debt through the year, even with the investment plans we have into Crestchic. And they are significant. We are planning to build the hire fleet quite significantly this year.
And is it sort of like all hands to the pump now to grow Crestchic is organically, rather than, you don't need to do acquisitions? The opportunity seems to be on a like-for-like basis.
I think, yeah, the absolute focus is on organic growth, because that's under our control. Yeah, we know our markets, we know our products. They're strong markets at the moment and likely to remain so for the foreseeable future. So that has to be our absolute focus. It doesn't mean we won't contemplate acquisitions if the right business comes along at the right time at the right price. But we're not actively out looking for them. People do run them by us from time to time, but that's opportunistic for us rather than strategic.
Okay. And then just finally, it'd be remiss if I didn't ask you about the new director appointment, Nicholas Mills, who I understand I presume is the son of Christopher Mills for Harwood. And Nicholas has a similar sort of very astute investor reputation. Can you just talk us through that appointment? Because it's a huge sort of like credit to the business that it's managed to attract somebody of that ilk onto the group's management team, or onto the board anyway.
Yeah, well, we're very positive about it. I mean, it came about because the management of the Gresham House Strategic Fund moved from Gresham themselves to Harwood some months ago. So Gresham, who have been a major shareholder of ours, as you know, for a number of years, been a very good shareholder of ours, I have to say, that supported us with a convertible loan note and a variety of other things. They suddenly became a relatively small shareholder, though they still have a noticeable holding. And Harwood entered the frame. And interestingly, I first met Christopher Mills probably 20 odd years ago in a totally different capacity. So we sort of remembered each other from those days. And yeah, he and his company are impressive, and it's great to have the pedigree of them behind us. We met very quickly when it became apparent they were going to take over the fund. He listened to the story. He liked the story, decided that Crestchic should be not only a hold, but a build. And lo and behold, he inherited 13% from the Gresham House Strategic Fund to come under management. And he's now up to nearly 23% with purchases in the market. So they're a very, very supportive shareholder. And obviously, when you got up to 23%, it's unsurprising that they'd want to have representation on the board. And Nick is a very, very smart man.
Yes,
he's going to be an asset to the board. Yeah,
fantastic. Well done. I mean, well done across the board. I mean, Crestchic is absolutely flying. You've done a really good sort of disposal of Tasman. Just a last bit in the Middle East to do, and the outlook is positive. You've got expansion plans, and you've got a new director. So what's in store going forward elsewhere? Then you sort of like ticked all the boxes so far.
Oh no, there's lots coming down the pipe. I think one of the things that we're really looking forward to in about 4 weeks' time, we've got a Capital Markets Day scheduled. It's going to be a virtual Capital Markets Day. We'll screen a presentation and then take live video Q&A. And the whole purpose of this is to get a bit more granular on strategy now that we've got the foundation stones that we set out to achieve last year are all firmly in place. But also the exciting thing for me is we've really built the management team in Crestchic over the last year. And it's going to be the vast majority of the presentation is going to be delivered by the Crestchic management team, so that investors will actually be able to get a level down from me. They've heard me talking many a time. They're probably fed up with me. But they can actually get down and dirty with the people who are delivering our strategy and have come from some really big organizations to join us, and they'll hear the story of why they've chosen to join us and what they're going to do for us. And I think it's an exciting story. So we'll be looking for you to help us publicize the event and make sure we've got lots of people watching.
Okay, well, yeah, I look forward to watching it myself and asking a few questions. So thanks very much for your time, Peter, and really well done on today's update and the past 18 months or so. So look forward to also in hearing what how the business develops in 2022.
Thanks, Paul. Always good to be with you. Thanks. Bye.